I've been having a bit of fun with this on X, how it started and how it's going. 2025. Look, I'm not against cryptocurrencies. I'm not against Bitcoin, but I'm against perma bulls of everything. Anyone who's perma bullish on anything is just being amateurish. I'm not perma bullish about gold. I'm not perma bullish about silver. And you shouldn't be perma bullish about cryptocurrencies or Bitcoin either.
Surfer, would like to make them your best friend. Balances in your bank instead. What's up, everybody? StackingSurfer here, and I've got another awesome interview for you guys with Kevin Wadsworth. And you can find him on X at Northstar Charts, or you can find him at northstarbadcharts.com. Kevin, welcome to this to the interview today, I guess. I'm glad to have you back. It's been a little while since we chatted, and you know, it seems like we just can't even keep up with this year. It's been one heck of a year as far as gold and silver goes, with the price action moving up. You know, I know we've talked a few times about coming back to test 200-day moving averages, and I don't even feel like we've come close to doing that. And it seems like it's just going to continue to go up forever. Do things ever go up forever in a straight line?
What goes up must come down, Jared, as they say, and you can see that in the 1970s, and you can see that in the 2000s as well, of course. So we shouldn't expect it to be different this time. So we need to be alert for the next significant pullback. But there are some things that we know, some things that we don't know. One thing that we do know is that we're transitioning into a precious metals bull era. So far, we've had a bull market, and we're transitioning into a bull era. A bull era is something that's defined by gold outperforming the stock markets over multiple years, and gold is breaking out versus the stock market at the moment. And if it wasn't for a small number of tech stocks in the S&P, then gold would have broken out very convincingly versus the S&P, as it has done versus the Dow Jones and other stock indices as well. So gold has very much broken out versus the equal weighted S&P index. So the vast majority of stocks and sectors in the S&P are now in deep bear market territory versus gold. And as a result of that, the miners are starting to do well as well. So what we do know is that we're transitioning into a bull era, which we can expect to last multiple years. What we don't know in fine detail is just when exactly the next significant pullback will come. When I say significant, I mean probably of the order of 20–30%. Could be a little bit more. Sometimes silver pulls back significantly more than gold. So if you think in terms of 20 or 30%, and then if it's a little bit more than that, well, great entry point. And if it's not, then happy days. But that sort of a correction lies ahead, and we need to be alert to when that comes. And silver is probably pretty key to that at the moment. I can explain that by sharing some charts if you like.
Yeah, let's do that. I'd love to look at that, because we have a now that have been buying gold and own gold, but at the same time, I think we have a large percentage of people in the community that are pretty heavy in silver. And so, you know, a lot of them have owned silver since 1980. They went through that rise and fall. They were also around in 2011. Some of them have been unloading very quickly because they feel like, okay, we've hit the next top. I need to finally get out. I've been waiting 45 years. But I'm also seeing that we have a cup and handle formation that has been confirmed, which would tell me that maybe things are a little different this time.
Yes. Okay, let's try and break that down so that we can help your viewers in terms of what they should be doing right now. So I'm just going to hit my screen sharing option. And we're going to kick off with the gold chart here, Jared. And just to point out, I'll hide a couple of these indicators just to make it a little bit clearer. I'll get rid of some of these lines for the time being. So what we're looking at here is the gold price going back to all the way back to the 1950s, but it was pegged, of course. Yep. So there's not much movement on the gold price until we get into the 1970s. By the way, you can analyze precious metals more efficiently going back further if you use silver, because of course silver wasn't pegged. So if you want to get a proxy for gold, just use silver back in the day. But anyway, the main things to notice about this chart: the big bull run in the 1970s, explosive move, the peg between gold and the US dollar was removed, and gold was allowed to find its market value, and it peaked somewhere up around $800 or so, as we know. Then it went into hibernation mode for 20 odd years before the next major move that took place just after the year 2000, where gold again rose by many hundreds of percent. And then we had this, as he just said, cup and handle pattern. If we zoom in on the chart, anybody that hasn't heard of a cup and handle pattern, I can just illustrate that for you. It's a well-known technical analysis pattern that repeats over and over again on many charts, and it can be used to your advantage. There's the cup portion of the chart, and there's a number of ways of drawing the handle, but my preference is probably just to draw it as another geometric arc like that. The alternative would be to define it with a horizontal resistance line and draw it like that. Either way, it doesn't really matter. It's a cup and handle pattern with the very traditional sort of handle in the top right hand corner of the arc, and it formed a 3-year consolidation. And indeed, back in 2019, we were able to identify this developing cup and suggested that a multi-year handle was quite likely, and that was because of cycle analysis, looking at cycle analysis with expected cycle lows around about 2020, in fact, around about 2022 to 2024. So the vertical lines that you can see on the chart, the red vertical lines, those are gold's 8-year cycle. So roughly, it's actually 7 to 8.5 years. So every 7 to 8.5 years, you get a low point, and the cycles are measured from low to low, not high to high, but low to low. The high point in the cycle can occur early in the cycle, or it can occur late in the cycle. That's why they're not measured from high point to high point, because it varies so much from one cycle to the next. But the low points are what define the cycle. So here we go: 1976, 1980, 84, 1992, 2000. These are all roughly, give or take, 8 years apart. 2008, early 2016. Then the next one, a little bit of an anomaly there. You'd expect 2024, but the low point occurred a little bit earlier, perhaps, than you might expect in late 2022. So it's about 7 years, roughly speaking, from low to low there. But that's, things aren't perfect in this world, and cycles are no different. So you have to give it a little bit of flexibility and leeway one way or the other, because the cycles are kind of pulled one way and another by what's going on in the real world, in the economic cycle and so on. So if we take that 2022 as being the 8-year cycle low, or 7 to 8 year cycle low, the next one might be expected in around about 2030 or so. Now, if it's 7 years, it'd be 2029. If it's 8.5 years, it'd probably be somewhere in actually early 2031 sort of thing. But we've got a zone over here for the next sort of cycle low. Now, given everything that's going on in the gold market and precious metals and gold transitioning into bull era, you'd expect this cycle to be right translated. So the high point should occur to the right of the center. So if I go for the earliest 7 year, so it'd be sort of September 2029, if that's where the low occurs, and it shouldn't occur any earlier than that, then you'd expect this to sort of zigzag its way. Let me just draw a little path for you.
Okay. Love it.
Maybe we go up to 5,000 or something, then we come down a little bit, then we go up and down, and then at some point it's going to come down into an 8-year cycle low. Now, it could be on the support line there at $3,000, or it could be considerably higher at, I don't know, $5,000. We don't know the values, we just know approximate timing in terms of what's probable. And at this point, I just wanted to show you one other thing. When we do technical analysis, and this is important, we look at chart patterns, we look at indicators and moving averages and things like the Ichimoku cloud and cycle analysis, ratio charts, Fibonacci levels, Elliott wave, stage analysis, the list goes on. So as it says here on the right hand side, none of these are going to tell you what the price will do, but if you add them all together, you get a weight of evidence, and it tells you what is most likely to happen. So any good sort of forecaster, whether you're forecasting the weather or whether you're forecasting the outcome of a horse race, or whether you're trying to diagnose a patient in a hospital, you don't look at one piece of evidence. You look at the full picture, and by doing that, you hopefully will get a probabilistic forecast of where price is likely to go. So the probabilistic forecast, taking everything into account, is that we are in this gold bull era that is going to lead up to, in my view, at least $16,000 by approximately 2035 after this cyclical low. Why 2035? Well, because gold is just breaking out versus the stock market now, and it's usually about a 10-year time frame for the gold bull era after that. So again, based on the 1970s, based on the 2000s, based on the 1930s, that's the type of time frame that you would be looking at for
so
gold.
Kevin, just real quick on that, if you go back a little bit on your chart to the 70s, and I even see this, I think I can't see the exact years, but you can see that you can have an upward momentum for two of those cycles. It doesn't mean that like every other cycle is going to go down or every other cycle is going to go up. What you're describing is these 7 to 8 year cycles roughly are based on the low to low. So it's possible, as you're describing here, that we could have the cycle end around 2030, and then we could have another 8 year cycle that continues to have upward momentum for gold.
Yes, and there's a neat trick for knowing if that's going to happen or not. So all of this is being powered by capital rotation. So capital rotation was spoken about before, and this is capital rotation. So the entire precious metals bull market is being powered by, sorry if it's a little bit hazy, but I'll just describe these boxes for you. As these boxes turn red, we are entering a gold bull era. So this happened in the 1930s, the 1970s, and the early 2000s. So this goes back to gathering all of the evidence. So the first box is US money supply versus gold, and it's now in a bear market. The US dollar index is the relative strength of the US dollar. And if the relative strength of the US dollar cannot outperform gold, then that's an indication that you are entering a precious metals bull era. So DXY underperforming gold in a bear market, and that is the case now. Consumer prices versus gold in a bear market, producer prices versus gold in a bear market, currency in circulation is now in a bear market priced in gold. The equal weighted S&P is in a bear market priced in gold. The New York Composite, the Dow Jones, the Wilshire 5000, the Russell 2000 are all in bear markets priced in gold. The S&P and the NASDAQ are transitioning as we speak into a bear market priced in gold. Arguably, I could color these boxes red now, but I've chosen not to because we're waiting for the capital rotation event. The capital rotation event is the culmination of this capital rotation process. And the capital rotation event is when the stock market falls by, let's say, 25, 30%, and then enters a period of many years where it's not able to outperform gold and takes approximately 10 to 15 years to get back to where it started. So that's the capital rotation event, and it's confirmed when the stock market breaks down in a major way after all these boxes have turned red. So that is what we mean when we talk about capital rotation event. And just to further clarify that, I think this chart is a little bit clearer. It's not quite so fuzzy. So yeah, money supply, US dollar index, all these things that I've just mentioned. And the S&P and the NASDAQ are currently in the process of transitioning into a bear market priced in gold. In addition, these are all in full. When I talk about them being in a bear market priced in gold, I mean that they have broken down below bull market support lines, below long-term moving averages, and below technical indicators like the Ichimoku cloud, which is the chart has to be above it to be in a bull market. And if it's below the Ichimoku cloud, you're in a bear market territory. So communications versus gold is in a bear market. These are all the 11 sectors of the S&P 500: consumer discretionary, consumer staples, energy, financials, healthcare, industrials, materials, real estate, and utilities. If you're invested in any of those, you really shouldn't be, because they're in a deep, developing and worsening bear market priced in gold. So if you're invested in any of them, you would have been better off just being invested in gold and gold-related assets.
What about the Magnificent Seven and NVIDIA?
Yeah, well, we can take a look at that.
To me, it looks like that's really the last few companies that are holding up.
Absolutely.
Market,
Let me just get the capital rotation evidence for you. Let me just right here. We've got the let's find the stocks. There we go. So we've got Tesla. Start at the top. Tesla priced in gold. Okay, so I'm just going to put it on the monthly time frame. I'm going to put those indicators back on the chart. So I'm going to put the 36 moving average, 36 month moving average, and the Ichimoku cloud. When you are below the 36 month moving average and below the Ichimoku cloud, you're getting into bearish territory. But that can happen, and then you can recover from that. So I've got a support line on the chart here, this red support line, which is a little bit like the previous one there. And if we break down below it, then Tesla is in a bear market priced in gold. But what I would say, and I'm just going to put it on the candle chart for a moment, is that it's worth bearing in mind that Tesla has fallen more than 50% priced in gold since 2021. And what else has been what else peaked versus gold in 2021? Bitcoin peaked versus gold back in 21. At least not quite true. I think Bitcoin just about got up to its previous peak priced in gold before rolling over. So Bitcoin hasn't made and sustained new highs versus gold since this 2021 timeframe. Amazon versus
I think
gold.
a lot of times when people are looking at Bitcoin, they forget to look at the price in gold. They just look at the nominal price of US dollars.
Yeah, exactly.
And they see new all-time highs, and they don't, and I think this is an important point to bring up for people too. When you start to price things in gold and you use that as a baseline, it changes your outlook on real estate, stock equities. It changes the perspective when you're looking at cryptocurrencies and Bitcoin as well.
And I'll tell you why it's so important. And I think crypto and Bitcoin aficionados find this hard to stomach, but it's important because when you have a capital rotation process, and this is the fourth one in 100 years, where the capital is rotating away from stock markets towards precious metals, when that happens, not only are you in a gold bull market, you're in a gold bull era. In a gold bull era, you should price everything in gold. When you're not in a gold bull era, you should price everything in the S&P, not in the dollar, but in the S&P. So you should use a ratio chart and price your potential purchase in the S&P, because if you're not outperforming the S&P in a stock market bull era, then you should just be invested in the stock market. And similarly, in a gold bull era, which is what we're in now, you know that gold is outperforming the dollar, you know that gold is outperforming the stock market. So whatever you're about to buy, whether it's platinum, palladium, copper miners, you name it, whatever it is, it has to be in a bull market versus gold, because if it's not, leave your money parked in gold or potentially silver if silver is outperforming gold as it is at the moment. So
I think it's important because I think too many, especially when you get into the more investor and the trader side of things, maybe more the investor than the trader even, but sometimes we chase our tails and we work way harder than we need to, because we're trying to outpace indices, or we're trying to outpace the underlying S&P 500 or gold, when in the reality is if you really don't have the time to do more of the trading, a lot of times parking it in your funds into one of those two can be a great solution for you, take some stress off, and you're still going to get that benefit of those markets.
Yeah, and you can completely outperform the traditional 60-40 portfolio by just holding your funds to a very large degree in the S&P, and then switching to a very large degree into gold when you get this rotation. You're not going to lose in a gold bull era by parking money in gold for 10 years, and you're not going to lose in a stock market bull era by parking your finances in the broader stock market. because these are big economic cycles that favor one or the other. So for some reason, this isn't common knowledge, and I really wish it was. But
it's not. Well, and I love that you're using the term era versus just a bull run, because I think it helps people understand that it sounds a little bit more long lasting. It's something that's more substantial than potentially, with runs. I think people get in their head that it's a short lived thing, and then it's going to come crashing back down really fast. Tends to create a little bit more anxiety versus understanding that there's going to be up and downs over a longer period of time.
Yeah, absolutely. Just to finish answering your question earlier, Amazon is down 48% versus gold, and is really getting into a technical bear market here. It's below the long-term moving average, below the Ichimoku cloud, and you can see it's broken below critical support. So Amazon, although it might look great versus the US dollar priced in dollars, when you price it in gold, it's down, nearly 50% there. Google still looks okay, but it's up against upper resistance here. So if we get a rejection here, and if we start to see this moving down, then that's going to be further confirmation that something is going on here. But Google is still looking okay, and it's still in bullish territory, even priced in gold. Apple, not so. Apple is down 34%, priced in gold, and is below the moving average and below the Ichimoku cloud. And that looks bearish to me. It looks like it's doing a bearish back test of the underside of the Ichimoku cloud there. So Apple is transitioning into a bear market priced in gold. Microsoft is really into a fairly convincing bear market priced in gold. And this one, if we just look what happened back here in the early 2000s, the chart broke down and it gave us plenty of warning that we were going to be in a massive gold bull market and the tech sector was going to collapse. You can see back in the 1990s, we're in a massive tech bull market, and gold, kind of collapsed. It fell, something like 70%, didn't it, from $800 to $250. So gold plunged, and tech soared, and then the opposite happened after the year 2000. So, the next cycle was a huge tech bull market and gold rolling over, and that happened in 2011, 2012. And what's happening now? Well, quite the opposite. We've topped. There's a topping pattern here. We've broken down. We've back tested the breakdown, and now we're transitioning downwards in a bear market environment below the long-term moving averages, the 3 and the 4 year moving average, below the Ichimoku cloud. And I'm not sure how much this has fallen, but I'll just measure it for you. Again, it's something of the order of 40% or more. Meta versus gold. Interesting sort of megaphone pattern thing going on here, but it's not bearish versus gold yet, but it hasn't made any progress versus gold since 2018. And go all the way back to 2018, and that's, we're at the same value priced in gold as we reached back in 2018. So Meta hasn't really made any progress in 7 years versus gold. And Nvidia is hitting overhead resistance priced in gold, and it just doesn't seem able to bust through that. We're still above the 3 and 4 year moving averages and still above the Ichimoku cloud there. So Nvidia is hanging tough there. So we've really just got a couple of tech stocks there that are holding up okay against gold. But even Nvidia hasn't made new highs against gold for nearly 2 years. So I think a lot of people will be quite shocked to that, to know that Nvidia hasn't made any new highs priced in gold for a couple of years. So
that I don't think I wasn't even realizing that. I don't think very many people are realizing that. They're seeing the big price action move in it. And that's the issue when you price something in dollars, and you continue to see it going up, you forget gold's been going up this, for several years as well.
Exactly. And that's relevant because it only happens under certain circumstances. You need a particular set of circumstances that only come along every couple of decades for that to happen, and for all of this weight of evidence to fall into place. Now, this chart, again, back in 2019, we put out the cup and handle forecast for silver and suggested that we would be hitting $50 by the end of this year. And, that's where we are. And in fact, if we zoom in and we just pop it on the candle chart, we can see that we've got a monthly close, albeit a very marginal monthly close above that resistance line.
Okay.
See that green candle there? So it was a close above the resistance line, but it was marginal. And I've drawn that line as accurately as I can using the line chart, which plots monthly closes. So you can see that resistance line goes back to 1980. It passes through the 2011 high, and I was expecting a reaction at that line. Well, if we zoom in onto the daily time frame, that is a bit of a sort of a wow moment. What was a bit of a wow moment for me, because that massive 40-odd year, 45-year cup and handle resolved with another cup and handle here that played out over 6 weeks. So a massive 46-year cup and handle, and then just lo and behold, just below the breakout line, we had another cup and handle pattern. Hopefully you can see that there, and it's even clearer if you put it on something like the 4-hour time frame.
Oh, yeah.
You can see that pretty beautiful cup and handle. So we got a reaction underneath the 46-year resistance line, and what's happening right now is curious, isn't it? We're just up, down, up, down, up, down. I know we've got an interest rate decision by the Fed coming up. This recording might go out just before or just after that decision, but what I would say is, for those of you who are, and we spoke about this just before starting the recording, Jared, we spoke about how people will ask me, Kevin, should I be buying gold and silver now? I'm on the sidelines. Or they might say, Kevin, I'm in gold and silver now. Should I sell? Okay, so let's just
question.
let's try and tackle that, shall we? Because first things first, it depends on a few things, and I don't know. When someone asks me that question, I don't know, and I don't want to know the answers to these questions, because I'm not a financial advisor. So I don't want to know anybody's individual circumstances. But this is what you have to ask yourself: what is my risk tolerance? What is my time frame? What are my goals? I think those are 3 main questions: risk tolerance, time frame, and goals. Because are you a swing trader? So in other words, are you buying gold and silver to trade it over a time frame of a few weeks or a few months? So let's say we've got a 10-year continuing big picture bull market for gold and silver now. If you're a trader, you're not looking to buy now and sell in 10 years time somewhere near the top. If you're a trader, what you're looking to do is, for example, buy a breakout from a technical chart pattern. Let's say, let me see if I can find an example here somewhere. Let me just pop it on the daily time frame, might make it easier.
Okay.
If you're a trader, you would I usually use the weekly time frame for trading. So, but the same principle applies whether you're trading on a weekly chart or a monthly chart or a daily chart. So you look for the breakout through key resistance. So there's a key resistance level there, and we broke out back in 2024 somewhere around $26, and we were covering the move that also had a horizontal resistance level. I think it was somewhere near $28 up here somewhere. There was a horizontal resistance zone that went all the way back to 2011. So it's fairly clear that that was a major breakout. So if you're a trader, what you would have done, and this is massively important, if you're trading, you have to know before you put your money into it, where are you going to get out? Okay, so as a trade, you would perhaps have looked at that resistance line and said, I'm going to trade it to somewhere near that resistance line. I'm going to place my stop loss just below this swing low here. You see that swing low in February? You would sit your stop loss just below that swing low. And if you look at what it says on the metrics there, it gives you a risk reward ratio of 3.6 to 1 or 3.7 to 1. That means you would risk $1 to potentially win $3.6. So if you risk $1,000, you potentially will win $3,600 on that. What do I mean by that? Well, what I mean is if you enter here and the price comes all the way down to your stop loss, that's your stop loss at the bottom of the red zone, that's where you exit, because price has gone down too low and something's wrong. Something's not happening the way you expect it to. If you go below that swing low, you're making a lower low, so you need to be out of the trade. So that's your stop loss.
Yeah, it's time to
your
get
profit limit is up here. So the green zone is bigger than the red zone, so your potential win is much larger than your potential loss. And at that point, you have to decide, right, okay, well, let's say I've got $10,000 saved up, and I'm going to risk, I don't know, I'm going to risk $1,000 on this one. So if it works out that you hit the stop loss first, you're going to end up with $9,000 instead of $10,000. And if you hit the profit limit first, you're going to be able to add $3,666 to your $10,000. So you'll have $13,666. So that's how a trade works. Okay, so trading.
Kevin, to stop you for a second too. I think for anybody, first off, as Kevin mentioned, we can't give you guys financial advice. You got to do your own research on this. But what Kevin just demonstrated there is if you're trading and you're buying and selling, say, mining stocks, for example, or the ETFs on gold and silver, for example, it's important that you understand how the charts work and you understand how these patterns work too, so that you have a better indicator of your potential upside and your potential downside. Otherwise, you're starting to just gamble and you're just throwing money at things that you don't fully understand. And then when emotion sits in, people tend to sell at the wrong times. They buy at the wrong times. And that's one of the things I like about, when you start to get into charts, especially if you're on the trading side of things.
Yeah, so it's what's referred to as risk and money management. Yes. And all professional traders will use risk and money management of some form. It might not be exactly like I just showed there. I mean, that's a very standard risk money management calculation, but there are other ways of managing risk. For example, you could use the moving average and say that if the price goes below whichever moving average, then you would exit. And so that becomes your stop loss. But you still have to determine what your profit limit is. You need to know for a trade. You don't just leave it running ad infinitum and keep, kind of moving the goalpost. When you enter a trade properly, you are happy to exit that trade. And if the price carries on going up after you've exited the trade, you don't care, because it was just a trade. It wasn't a position. It's just a trade. And you move on to the next trade. You take that $3,666, add it to your starting position, and then you go into the next trade. And by doing it that way, if you make sure your reward to risk is always 3 or 4 to 1 or more, then you can have 60 or 70% of your trades as losers and only, let's say, 30% of your trades as winners, and you are still making money over the long term. Your pile of winnings gets bigger and bigger and bigger, even if you have more losers than winners, because you're using risk and money management. So at the moment, silver, if you're a trader, you're going to, whoops, I didn't mean to do that. If you're a trader in silver, you're going to be looking probably at, the next breakout. So I'll pop it on the line chart, and it's not entirely clear, I suppose, where the resistance line is and what you would call a breakout. Perhaps that red line there. Perhaps we're forming some sort of a chart pattern like that. It's not an ideal setup, because what you're looking for, ideally, is some sort of descending trend line or horizontal trend line, perhaps something like that. And if you get a third touch on that line, in fact, we have had a few touches on that line. So you could use that red descending resistance line. So if you're wanting to trade this now, you could have an entry somewhere near $59, let's say. And you could have your profit limit somewhere up in the mid 60s, your stop loss just below that swing low, and you've got a 3 to 1 reward to risk. Now, as it happens, and it depends on how you want to estimate the target as well. There's a number of ways of doing this. You can measure the depth of the cup and then replicate that on the breakout. But there's a deeper cup here, and you could say that that's the breakout, and so your move would take you somewhere into, I don't know, $66, $67, something like that. And that would be one way of estimating your profit limit, and that gives you a 3.8 to 1 reward to risk. So that's a trade. And so you have to think, if you're trading it, that's your answer. If you're investing, it's a very different scenario altogether, because if you're investing, and I'll pop it back on the monthly time frame, this is your chart for investing. And again, it's a question of, are you investing or stacking? Because stackers are a form of investors, but they just never sell. A stacker will just, you're the stacking surfer, so you know more about surfing and stacking than I do probably. But the principle of a true stacker is that they will just keep on buying year after year after year after year, treating gold and silver as their perpetual way of saving for the future. And regardless of whether you're in a bull era or a bear era, true stackers don't really care. So they will look at this chart and they'll say, right, okay, well, let me just get rid of this calculation.
It looks like it's going up, so
it's going up. So if it pulls back, a stacker or an investor will add to their stack or in their investment. Now, certain investors, depending on your mindset, you might not want to sit through, let's say we follow the green line there and we go up to $65 or $70.
Okay.
Many investors might not want to sit through a pullback to 40 or 45, or if it comes down steeply, it might be somewhere down near 40, 41, 42. It could potentially go significantly lower, but it's unlikely in my view. So I think there's some fairly strong support between $38 and $40. So that would be my sort of extreme downside at the moment. But if you're an investor, you might want to sell into strength anywhere between where we are now and sort of the mid 60s. And another reason for that, if we look at gold again, bearing in mind that gold and silver move together, just look at the indicator at the bottom of the chart there for a moment. I'm just going to put a horizontal line on here. That indicator on the chart there is the distance from 3-year moving average. So this little black line at the bottom, I'll just double click on it so you can see it more clearly. As it goes up, what that's telling you is that you're getting further and further away from the 3-year moving average. And at the moment, we're 65% above the 3-year moving average, higher than we were at any point in the bull market in the 2000s. So the peak of the bull market in 2011, we never got as high as this in terms of being stretched above the 3-year moving average. There's been a lot of energy in this move that has taken us a long way above the 3-year moving average. The only precedent that we have is the 1970s when gold came off the gold standard. So, this is an exceptional event. And you can see how the exceptional event sort of ended last time. Suddenly, we came all the way back down, and we ended up back down well below the 3-year moving average before the next massive move.
Market's moving like a pendulum, right? So if you have these big moves up, you tend to have a little bit more of a correction to it.
Yeah, the bigger the upside move, then potentially the more you're going to have to correct afterwards because it needs to be reset. People are going to be screaming at me saying it's different this time and we're having a monetary reset and all that kind of stuff. But what I'm showing you is technical chart evidence, not the narrative. So I'm ignoring the narratives for the moment. You might be thinking that we're in this type of a move from 1976 to 1980, thinking that we're going to come all the way up here to hit the upper red line of somewhere near $30,000. Well, that's not impossible. That certainly isn't impossible, but it's a low probability event. And one way of illustrating that, and
that would have to take some kind of events that we're not even aware of today to do, like something that I can't even think of to get us up there.
Yeah, something. Well, yeah. This is the gold silver ratio, and the gold silver ratio is broken down. We had this anomalous plunge in 2011, but I drew this support line on, and it passed through the lows in 2021 and 2024. When the gold silver ratio is dropping, silver is outperforming gold, and when it's going up on this chart, gold is outperforming silver. Gold tends to outperform silver when gold and silver aren't doing so well, because silver corrects more than gold does in a pullback. When the chart is plunging, it's during an energetic phase in a precious metals bullish move. So you can see this move that took place back in sort of 2019 to 2020, and that's when the metals had a good run and silver outperformed. And again here in the bull market between 2008 and 2011, silver in the second part of that bull market outperformed gold to a very large degree. But the whole pattern is a rising wedge, and we've broken down below it. So my expectation would be probably that we come down to test some support level down here, then back test, and then plunge down here somewhere. Whoops, I didn't mean to. My arrow's going all over the place, but you get the idea. I'll do that again.
Well, so let's look at that for just a second, Kevin. So, you know, we've had a couple of years here where we've touched up above 80, and then we got above 90, and we got up even above 100 on the gold to silver ratio, and now we're sitting down around roughly, I think, 72.
Yes,
or so. So, you know, looking at what you're describing here, because I can't see the details. I've got a small screen.
Yeah.
If we go back up and go to test that resistance line there, where it becomes, I guess, a resistance line potentially.
Yes.
What's
Yes.
the ratio?
What's the resistance line now? Yeah. Yeah.
What does it go up to? So you if you could just call out a couple of those points of where we're at on the.
Yeah, sure. Well, the breakdown line was around about 82, 83, and we've broken down well below that. We're at 72 now. If we go back to back test it, depending on the timing, it's going to be somewhere in the mid 80s, around 85, 86, because the line is rising. So somewhere around 85, 86 would be where you would expect resistance and then a drop. Now, let's just tie this in for a minute with another key piece of evidence, and it's the stock market versus silver.
Okay.
And this is something that I really don't think anybody else has covered. So it's important, I think, this. If you want to figure out what the hell is going on with gold and silver at the moment, just keep in mind that capital rotation is what drives the precious metals bull market. You need to have a relative movement of capital from stock markets to gold and silver, which means gold and silver outperform the stock markets. The stock markets can carry on doing okay as they are now, but gold and silver outperforming the stock markets. And then at some point, as a result of that, the pressure builds and the stock market cracks and plunges, and that's the capital rotation event. So CRE is a capital rotation event. We had one in roughly 1930-31, and stock markets collapsed. Another capital rotation event, which we're defining as a super capital rotation event, happened in the early 1970s, and this ratio dropped enormously as gold and silver rose by thousands of %. And then from there onwards, we saw the ratio going up as stock markets outperformed gold and silver. And then we had another breakdown in 2002, and we had a capital rotation event in 2002. And remember, in the early 2000s, the S&P fell 50%, okay, in 2002 or thereabouts, whatever it was, 2001, 2. And then again in 2008, the S&P fell 50% approximately again. So it had two drops of around 50%. And that is your capital rotation event that gave the power to gold and silver to outperform, not just gold and silver, but energy, oil, and the commodities complex. So whilst gold and silver are doing all of this fantastic stuff, other commodities at various points will have their chance to briefly outperform gold and silver, but not for very long. Gold and silver are at the heart of all of this. So look at the pattern that we saw in the 1950s and 60s. 1, 2, 3, the ratio dropped. Now remember, when the ratio is going down, silver is outperforming the stock market. So it came down, and we had 1 touch, 2 touch, 3 touches on the super CRE line to define that line as being massively important. This is on the quarterly time frame. So in that quarter, the chart, if I just put it on a candle chart, it actually went a bit lower than that. And you can see we actually briefly fell below that super CRE line before closing the month back above it. So that line is really important, because then what happened, silver, when it hit that line, silver peaked, okay? And then the ratio bounced. And when the ratio reached its high point in 1971, which was 3 years later, that's when silver took off. And the ratio plunged, and silver massively outperformed, and the stock market took 10 years to recover. So fast forward to today, 1, 2 touches on the super CRE line. We're coming up to the 3rd touch. Okay, 1, 2, 3, plunge, and we're approaching that line. So if this isn't sending shivers down your spine, I don't know what will, because as this ratio hits that super CRE line, I fully expect a reaction, and I don't think the reaction is going to be good for precious metals. What we can say is that if this ratio just slices through that line, a little bit like the gold-silver ratio has just done, then you're going to get a back test to verify that line, because it's a valid and important support line. I think one way or another, it's very unlikely that we're not going to get a significant reaction to that line. So for me, I think silver has a good weight of evidence, or good probability, however you want to put it, of outperforming the S&P, and I can measure it for you, and I'll tell you by how much.
Yeah,
from where we are now down to that line is rough. I'll just zoom right in so you can see it in more detail. From where we are now to that line, depending when we hit it, is probably about 13 or 14%. So if the S&P is going up, then it means, so say the S&P goes up by 10%, it means silver is also going to go up 10%, but then it's going to outperform it by another 13% on top of that in order to hit that line. So, it's like a moving goalpost, which is why ratio charts are so brilliant, because you just pull up the chart and it doesn't matter what the price of S&P is. Doesn't matter.
It's all relative.
It's all relative, and this chart will tell you when the ratio has reached 101 point. Let me just put my line on. So it's going to be 101.8. So when the ratio falls to 101.8, that would be a strong signal to exit into strength. So if you're looking as an investor, going back to what I was saying before, if you're an investor and you want to avoid being caught up in a significant drawdown, and you want to use a weight of evidence to help you exit into strength, then this ratio chart will help you do that. You could start to, and this is another thing as well. It's not an all or nothing situation, Jared. If you're an investor and you're wanting to protect some of your gains, it's not an all or nothing thing. If you've got $100,000 invested in silver, you don't have to sell $100,000 worth of silver. You can exit in tranches. So you could exit, let's say 20% of your position now, or just take your profits off the table, or take your initial stake off the table, whatever you want to do, whatever your risk appetite, your approach to risk tells you to do. Between now and hitting that line, because we're getting quite close, you could start to take some of that risk off the table. And if we start to break down below that line, you can start to add risk back to your position. But look, in the grand scheme of things, if we're right, and if at some point in the future this really does break down as it did in the early 2000s, or even more massively as it did in the 1970s, then we've got a very long way for silver to go. If silver goes to 70 or 80 or even $100 now, and then falls to, I don't know, 40, 50, $60, whatever it falls to, that's just peanuts compared to several $100 where silver is going to be when this ratio drops. So hopefully with silver now being above $50, people can start to realize that $100, $200, $300, even $400 or $500 silver isn't something to dismiss. And also, there's no reason to say that it's going to be the end of the world either, because here silver rose by, I don't know what it was off the top of my head, say 1,000%, and back here silver rose, I don't know, about 2,000%. So these things have happened historically, and the world didn't end. So it's just a reflection of loss of purchasing power, and the precious metals are repricing back in that loss of purchasing power. And another metric that we can look at to just help us define the capital rotation event is the Dow to gold ratio, which a lot of people might have come across, and it shows the signals that we've had in the last 100 years. Signal number one, breakdown, precious metals went bonkers, gold had to be repegged, silver went crazy. Signal number two, big breakdown in the 1970s, gold and silver. Well, gold, the Dow fell 50%, Gold doubled, and then it doubled again, and then it doubled again, then it doubled again, then it doubled again. Even in the 2000s, it wasn't a super CRE, but the Dow fell over 50%. Gold doubled, then it doubled again, and then it doubled again. So gold has already gone from, let's say, $1,500 to $3,000, or you could say the breakout was at $2,000 and it's doubled to $4,000. So we've basically done one double already. It should double again, then it should double again, and then it should probably double again after that. So you start to get an idea.
This next gold era.
And that's it. Yes, this is a breakdown, just as we had in the 1930s, as we had in the 1970s, as we had in the early 2000s. The chart is very, very clear. This long-term chart has broken down below the 8-year moving average, below the Ichimoku cloud. And we're using the 8-year moving average here because it's a very long-term chart, and gold has a roughly 8-year cycle. So the ratio moving down below the 8-year moving average is very important. So you bring to, I could go on for hours with this sort of stuff, but you start to bring together this sort of evidence. This is gold versus the S&P breaking out. So, that Dow to gold ratio was breaking down, Dow underperforming gold, and this is gold versus the S&P. And on this chart, when the ratio is going up, it's gold outperforming the S&P 500. And you can see that happened in the 1920s and 30s. It happened here in the 1970s, and in fact, it also happened here in the early 2000s. In fact, if you look at the chart pattern here in the 1970s, at that super CRE event, and you look at the chart pattern now, I don't think you need to be any kind of an expert to see the similarities between these two chart patterns. It's a cup pattern, not a V-shaped pattern. It's a cup-shaped pattern where you got a gradual reversal of the ratio, taking the ratio back above the green line, which is the 48-month moving average, or it will be in a second. And it took you above this red and green splodge, which is the Ichimoku cloud. Notice bear market for gold when you're below that Ichimoku cloud, bull market for gold when you're above it, bear market, bull market. So what I've done here, I've replicated the move from the 1970s just to give a rough idea. And look, if we just zoom in, look how similar the ratio has performed. That red line, it's moved almost lockstep with the 1970s. So what it's suggesting is that we may be in the final little peak just now before the ratio pulls back for a while. And we don't know how long. I'm not going to pretend I know how long. It could be 6 months. It could be what I would in my mind, I would try and sort of condition myself to expecting most of 2026 to be disappointing for gold and silver. So whenever we peak in this run, whether it's this month or whether it's next month or whether it's February, that peak I think is a major peak, and then we're going to have many months of downside price action. I don't know exactly how long, but we're going to use the technical analysis and the ratios to identify when it's breaking out again. So it doesn't really matter how long. We'll have given people information they need to make the decisions they need to make in terms of taking risk off the table. And so therefore it's going to be great, because those that aren't positioned, hopefully they've seen our work and they're now convinced that we know what we're doing, and they'll be able to take a position and be positioned for these huge moves that are fully expected to take place over the next few years. So it's a big evidence puzzle. And just sort of one final chart, really. I've been having a bit of fun with
that one's fun.
Yeah, I've been having a bit of fun with this on X, how it started and how it's going. 2025. Look, I'm not against cryptocurrencies. I'm not against Bitcoin, but I'm against perma bulls of everything. Anyone who's perma bullish on anything is just being amateurish. I'm not perma bullish about gold. I'm not perma bullish about silver, and you shouldn't be perma bullish about cryptocurrencies or Bitcoin either, not without technical evidence. So, all of these, I don't know if they're paid accounts or shills or whatever they are, they're putting out random statements that Bitcoin is going to, what does it say there? The next 6 to 8 months will be life-changing. And that was in February. Well, here we are sort of 9 months later, and silver's up
Well, I
overnight.
saw another one just on Bitcoin for fun here, that showed all the predictions by place. Some of them were as high as $1 million that it would hit $1 million this year,
Yeah,
and those can be so dangerous because some people will base an entire financial decision off of that without doing any research.
if you see a tweet like that, that is just a simple statement that sounds like they're just trying to advertise
Yeah,
Bitcoin with
guys.
nothing to back it up. I mean, what is there to back it up? No chart. There was no evidence, no weight of evidence, just a hodl mentality that we're going to the moon. But, you know, for a while in 2025, Bitcoin did okay. Well, ish. And, you know, okay, at least it kept track of the S&P 500 anyway. And it was kind of matching the performance of silver for a while. But the capital rotation process that I've been describing to you is the reason that all we've done at NorthstarCharts.com, all we've done this year is trade Bitcoin. And we've had some great trades in Bitcoin, but we haven't been positioned in a long-term position in Bitcoin because of the capital rotation process. We knew that because gold and silver are beneficiaries of capital rotation, and because Bitcoin doesn't track gold and silver, it left a very big question mark over whether Bitcoin would keep pace with gold and silver. And the ratio chart kept us out of Bitcoin because it wasn't breaking out versus gold and silver. It was breaking down at the start of the year. And of course, now we can look back in hindsight, and silver's up over 90% and gold 55 or 56%, and Bitcoin is down on the year. So, you know, just a word of warning, a word of caution, really, Jared, for these accounts, you know, wherever they are and wherever they come from, not to just believe stuff because it appeals to your bias. You know, I'm not biased towards gold and silver. I'm biased towards the evidence. And if the evidence tells me that, you know, it's likely that one or the other is going to outperform, then that's where I'll be investing without any kind of narratives or fundamentals needed. Whether it's, you know, we've got a crypto-friendly president, we've got ETFs, we've got M2 money supply going through the roof. All these narratives have come and gone, and the one thing that stayed constant is the fact that Bitcoin is in a bear market versus gold at the moment. And until that changes, why would you even look at Bitcoin? You know, so Bitcoin could go to $100,000, but if it's still in a bear market priced in gold, then you shouldn't be too interested in it.
Yeah, I agree. And I've got some friends that are pretty heavy in Bitcoin that are buying gold right now. They can see, you know, they can see some of those differences. So, Kevin, this has been awesome. There's so much that's in the charts. There's so much to go through. Like you said, we could probably do this for 3 or 4 hours and really analyze everything. I don't know that we'd have anybody watching after an hour, but
we send everybody to sleep, wouldn't we? But
yeah, at some point you got to sleep or your brain's going to break. But you've looked at charts too much if you're dreaming charts, guys. So if that starts happening, then you are a trader. And I don't mean that in the bad sense. I mean you're a swing trader. But the last thing I'll just kind of throw out there is I think it is important for everybody to do a little self-reflection on: am I acting like a trader? Am I acting like an investor or a stacker? Each of those 3 things is going to be a little different on how you approach this. Kevin's got some great charts that will help you through that as well. Because I think it's important, especially if we start to see the metals coming back down again, does not mean that we're not in a gold bull era. Okay.
Absolutely, and there's one little nuance to that, of course, is that you don't have to be just a trader or just an investor or just.
You can do all 3 of them.
I mean, I personally have an investment portion of my NAV, my net asset value, that is invested in gold and silver for the entirety of the bull era. But there's a trading portion that I use as well. So it can be useful just to decide before you start. Right, okay, I'm going to use 10%, 20% of my overall pile of fiat currency for trading, and the rest is going to be kept for investing and stacking. So just think about those definitions.
I think that's perfect. Because like for me, when I look at physical, I'm heavier physical in stacking, where I'm just wanting to move out of the dollar. I just want to be away from fiat. I'm going to hold it long term. It's going to go to my kids.
Yeah, and physical can be quite cumbersome to buy and sell as well, of course. So, you know, there are digital ways of getting access to gold and silver. There are a number of companies now where you can buy your gold and physical gold and silver. It'll be vaulted for you. I know people like to have gold and silver in their hands, and they like to have, but for me, in a vault is at least as safe as it is buried in my back garden or in the house somewhere. So, it depends on your risk appetite with all this sort of stuff. But I'm just saying you can hold gold and silver digitally and in physical form at the same time. So I use a mixture of these different techniques. I have some physical and I have some digitally, and you can use GLD, SLV to get exposure. There's a number of other different funds and ETFs, GDX, of course, for the miners, GDXJ for the junior miners, SIL, SILJ. So, kind of having a bit of a mixture of those things can be good.
I think so too. So I'll put out a video here soon for everybody that's watching this on what I do with that, because I actually have two different brokerage accounts. One's more of a trade, one's more of an investment, where I'm looking at mining stocks. I also use like Glint and One Gold, where I'm kind of vaulting my gold or silver, and I can move in and out of that. And then even with my physical stack, I have some things that I purchase that I sell on eBay that are almost kind of more like an investment or a trade, something that's maybe a little bit more rare. Maybe there's only 50 of them or 100 of them that are out there. And then I buy things that are more generic that I'm just going to hold on to. And, it's not easy to move 100-ounce bars of silver here and there. It's more of a local thing that people would probably do. But I'll cover that off and go into more of the detail. But Kevin, I thank you so much for coming on and doing this. For people that want to get a hold of you personally, understand more of what you guys offer, I know they can go to northstarbadcharts.com. Do you still have like any kind of a discount or sale going on for your services?
Yeah, we had a Black Friday deal that has just closed. But I'll tell you what, if people are interested and they want to take a look, and there's no risk involved, if you don't like what you see and you think we're a couple of clowns, me and Pat, then we'll give you your money back, no questions asked. But you can drop me either a DM on X or drop me an email at northstarbadcharts. northstarbadcharts@gmail.com. And you can get in touch with us that way, and you could get a little cheeky little discount code from me and Pat. But keep it quiet. It's just for the people watching the show.
All right. Well, thank you so much, Kevin, for coming on, and everybody else, thank you for coming. Please leave a comment down below. Would love to hear from you guys. What do you think? What are you doing? Are you guys investors? Are you stackers, or are you traders? And then also hit the subscribe and bell icon. That helps share this video with more people. And consider sharing it with a few more others that are out there. I think this information is so important, especially for those that may be kind of fixated in one area. So if you know someone that's just really heavy in gold or silver, or even in cryptocurrencies or the stock market, I think a video like this is very helpful for those people to understand that there's patterns, and that there are ways to better understand what's coming based on what's happened in the past, to help you get some, better foundation and bearings for what's to come. But Kevin, thank you very much. And everybody else, thank you for stopping by, and we look forward to talking to you soon. Thank you.